I'm Phil Eaton, the president here at Seattle Pacific. I see some faces that I don't know, and we welcome you to this afternoon forum. And as well, of course, welcome our students and our faculty and our staff. It's a time for us to gather in conversation, time for us to learn some things from some people who know a lot more than I know, I'll tell you. So we're going to have a wonderful panel talking about some of the intricacies of this whole economic environment in which we are all living. These are scary times, they're uncertain times, they are important times. And as a university, we commit ourselves to understanding what is happening as best we can, to engaging what is going on. That is a part of our purpose and our mission at this institution, and that's what we plan to do this afternoon. So we welcome you to this time. Let me say just a few things to start out. I just got a notice this morning. By the way, let me also say I'm a little off balance because I'm supposed to be in jury duty. I tried to get out of it. I tried to do my civic duty. For you students, I want you to know I model trying to do my civic duty, but my schedule is such that we tried to get me out of it, and they summarily denied my request to get out of jury duty. So I was called, and they said sternly to me, "No, you must show up on this date at 8 o'clock." So I was down in this huge room with 350 people, and then I got released about 11 o'clock this morning. I feel like I'm out of prison. But I have to go back tomorrow, if you can imagine that. I've got to do the whole thing and see my way through. I have no idea what I'm going to do if they call me for a jury tomorrow and say that it's going to last for 2 weeks. I'm in big trouble because we got a lot going on this campus, to be sure. Anyway, back to the subject. Let me frame just very briefly here what is happening. At this university and all universities, we're watching very carefully what is going on. We have tremendous expertise on our staff under Don Mortensen and so many others on our Board of Trustees. We are watching very, very carefully on a daily basis what is happening. We're monitoring that. We're monitoring the ways in which all of that impacts the university. So I want to tell you and assure you that that is going on. We have our eyes wide open. We are looking, we are watching, we're seeing what kind of impact this whole thing may have on us as a university. I read this morning that Arizona State University is cutting back 200 faculty members, is increasing their class size, their largest class size, from 300 to 1,000, starting in winter quarter. And the point is, huge budget situations are impacting that institution, and lots of institutions around the country. You may have seen that Mark Emmert, the president at the University of Washington, who called me the other day on on issues of the economy and what's happening with us and them. But he announced the other day that the University of Washington is going to have to cut back by $10 million to start with. By the way, the Arizona State University in this same report already has cut $30 million out of their budget and is asked to do another $25 million out of their budget. Now, they've got big budgets, but that's still an awful lot of money, and you can tell that the impact is happening at that university. A lot of that is happening because of the state economy, revenue within a state economy in Arizona, Washington in our case, a lot of other states across the country, and that's impacting public institutions big time. There is a lot of hand-wringing, a lot of searching about what to do and how to do it, how best to do it, how to respond to this economic moment. I say those things not to create any sense of concern and fear here, because we started our year in great shape as a university. Things are as normal. We are moving forward. We are moving forward with confidence. We, again, have our eyes wide open, but I want to offer you the assurances that we are in great shape, okay? But that's all to say, at the same time, we must be talking together, we must be watching, we must be monitoring, we must be taking great care as we move into the future. So I hope you get the feel of that. There's a balance in what I've just said, and that is we are in great shape. We are not making cutbacks. We are not anticipating those things. And yet, on the other hand, the economy is in this economic environment in which we live. We must be attentive to the possibilities that could come to our place. One other word, and then I will sit down and this wonderful panel will come and speak. And that is that we are also recognizing, attentive to the needs of our students and their families. This is where we believe the impact actually could happen on our institution, is how, in fact, it is impacting our families that we prize so much. We count you as partners. We count you as a part of our community, our students, of course, and the parents as well, and the families. And we're watching. Of course, you're watching. Of course, this is hugely important to you in the ways in which this whole thing is going to impact you and impact the possibilities of continuing your education. And we'll talk about some of that in terms of financial aid, in terms of our ongoing commitment to financial aid, our effort to do everything possible to make sure that we are moving through as a university with stability and with clarity and even planning forward into the future, and as well that our students and our families are being able to do the same thing. So this is a conversation we're having together, and it is wide open, and it is intended to be wide open. We hope that we really truly can have that conversation with you, and the effort here, as always, is to offer some sense at this moment in time, some sense of real assurance that things are fine. And that may not be the case for you individually. I understand that, so I'm not saying that in any glib manner, that's for sure. But things are fine at the university, and in fact, you know, as the future unfolds and as we watch what is happening, we have some tremendous confidence as we look out to the future at this time. So those are my opening sort of framing comments. Now we will really sort of dive into some detail, both in terms of the economy and all of these patterns that have sprung to our attention over the last month and 2 months, and some understanding of what this economic condition is and what these forces are at work, complexities of all of those, and so it's trying to, in some ways, educate ourselves further on what is going on. But as well, then, we have you know, officials from the university to be able to answer very specific kinds of questions. So I will invite the Dean of our School of Business and Economics, Dean Van Duzer, to come forward, and he will introduce the panel. Thank you all for being here.
Well, it's a real pleasure to be here, and glad to see so many of you here and interested in this subject. We're going to try to move through a couple of topics very quickly, but we want to do the best we can in terms of accommodating questions as we go along the way. One of the things we're experimenting with, I think for the first time, is we're going to have it so that you can text questions during the proceeding. They're being collected in the back and then zipped up to me up here. And so, you know, who knows if this will work, but we're going to give it a try. So here's the number if you want to write it down for your text. It'll also show up from time to time on a handful of the PowerPoint slides to remind you, but the number is 206-484-9052. Okay, I'll repeat, 484-9052. There are also some index cards for you low-tech types that would like to, at the back, just go and fill one out, leave them on the cards, and those will make their way up here as well. Our panel approach is going to be divided in two parts. The first part is to look at kind of the question of how did we get into this mess? And then the second question is what are the potential impacts on us, and specifically focusing on students and the life of the university. So with me here on the panel for the first part is Dr. Doug Downing. Dr. Downing joined the SPU faculty in 1983. He earned a PhD in economics from Yale University and a BS from Yale. They say with a double major, but when I read this out, you'll realize he actually has essentially 4 majors: economics, political science, astronomy, and physics. He has written several books, including a mathematics textbook trilogy in the form of adventure novels. In addition to teaching economics and quantitative methods in the School of Business and Economics, he teaches introductory astronomy in the College of Arts and Sciences and text and context in the University Scholars Program. He served as the chair of the SPU faculty. He served as the chair of the undergraduate committee at SPE. He's currently our study abroad coordinator, and he's led a number of our study abroad trips to China. So Doug is joining me here on the panel. Unfortunately for you, I am the other panel member. This is because I am channeling Dr. Dan Hess, who is our finance professor who truly understands all of this stuff. So my acquaintance with what I'm going to share with you probably dates back to the time when I was an attorney, where I actually practiced in commercial paper and in working in creating some of these unusual and bizarre credit instruments that have since proven to be so troubling. Not mine, I might add, but... So, with that, we also, breaking new technological ground, a la YouTube, have pre-screened a few questions to show video fashion, which we will intersperse as we go along, and I think we'll start with the first one.
Hello, my name is Ben Casper. I'm a senior, and I'd like to know a bit more detail, and like what does it mean to be in hard times? Looking for more detail about the crisis.
So a sort of general overarching question, which we hopefully will answer here as we go. So I've got a PowerPoint that I invite you to follow along with. How did we get in this mess? And so I want to start with kind of the way it was, kind of a simple picture. And believe me, all this is going to be way too simplistic. And as I make it simpler, I'm probably leaving some fine-tuned pieces out that should be in there. But to give you the big picture, simple bank. How does a simple bank get its money? Well, there's investors that put some capital in the bank. There's depositors that put their money in the bank. And then they can borrow money typically from bigger banks. Sometimes bigger banks borrow from the Fed, but they typically borrow from other banks. Then the simple bank turns around, as you might guess, and puts the money out in loans. My simple example, they're making home loans because that is a very central actor in where we're going. That means they move money down to the homeowners that lets them buy their houses, and the homeowners give them back mortgages. The mortgage is the security on their collateral or it reflects the security in their collateral and allows them, if they ever needed to go foreclose on the homes. So in the old days, the good old days, typical house purchase, the owner would, or the prospective buyer would probably have to come up with something like 20% of the purchase price as a down payment. The bank would lend, say, 80% on top of that. That 100% then, 20 plus 80, would be used to purchase the house, given to the seller. The buyer would then make monthly payments over the tenure of the loan, 15 years, 30 years, sometimes shorter, but those were the typical long-term fixed rates. Then, when the bank got the money back in the course of the regular repayment stream, it would turn around and send the money back to the folks that it had gotten money from. It would borrow or pay back borrowings, make sure there was money for the depositors, and return on the investment for the capitalists. So, pretty simple. That was kind of the way it all was. Now, the first kind of question that came up was, what do we do if the bank runs out of money to lend? I mean, there's limits on how much money it has. People still may need loans. So what happened, and this is still in the good old days, not just in the bad part here, what banks would do is they would gather up their mortgages and they would bundle them, and then they would sell them. And where they would sell them is what we call the secondary market. Now, there were any number of players in the secondary market, but what you would typically find is that the banks would send their money, and one of the big players in housing markets are what you hear of Freddie Mac and Fannie Mae. That's where they kind of enter this scene. Freddie Mac and Fannie Mae were kind of weird entities. They were created under a national charter, which is a little unusual, but they were privately owned. Therefore, individual private parties could invest in them. But they were always kind of managed indirectly or directly by Congress. And there was this broad spread expectation, but never stated, that if there was ever a problem, the federal government would jump in and guarantee them. And so the market kind of treated their stocks a little bit like guaranteed by the federal government. And so they are a significant player, as many of you know, in this process. So far, so good. What would then happen is that Fannie Mae, Freddie Mac, or other folks that are buying off these things would sell them often in pools to investors. Okay, so why would investors want to buy mortgages? Well, the answer is because traditionally, mortgages were very, very safe. In the old days, good old days, mortgages would default between 1% and 2%, and when they did default, typically the bank could turn around and foreclose on its collateral. Remember that the bank had lent only 80% of the value of the house against the house, and so the bank had already a 20% cushion in the down payment, plus the bank was counting on appreciation. As houses got worth more, then that kind of made their percentage of the house value shrink. And so they counted that they were reasonably safe, and they were reasonably safe. This word appreciation, it becomes one of the significant culprits in this whole story, because in the bad times, the bubble period, everybody began to believe that appreciation was inevitable and rapid, which meant that you weren't as concerned about things like, for example, the down payment, because you could make that up in the appreciation. But this is kind of the old traditional approach that would have been taken. The reason on top of this that investors would like this is that mortgages paid higher returns than, say, a treasury bill. So a relatively safe investment, but in fact a pretty good return on your investment, at least as compared to other investments along the way. So we have your typical fat cat investor over there who's sending money to Freddie Mac and Fannie Mae and getting back these pools of loans. Now here's maybe one place where I could introduce for you the simple concept of leverage. Because in fact, these fat cat investors don't necessarily put all of their own money into this. And by leveraging their investment, they can substantially enhance their returns. So let me give you a very overly simplistic example of what I mean. Supposing they're buying a pool of loans for, we'll call it $100, because it's easy to think about. $100 for a pool of loans, and at the end of the day, when they all pay off, they got 103 back. They would say, I put 100 of my in, I got 103 back, that's 3% return on my $100 investment. But if instead of doing that, what they can do is put in $10 of their own money and borrow $90, and we're going to ignore for the moment the cost of borrowing, which you really can't, but we're going to. So that means that when they get 103 back, they repay $90 on the loan that they owe, and they're left with $13 on their $10 investment, which means that their return on their investment is now 30%, not 3%. That's why leverage really juices up returns. Good thing, but it comes with a small catch. When the markets are going down, leverage really juices up the losses. And that's a big part of what has happened as this crisis has unfolded. Okay, so now we move from the regular old game to the new era. And there are a number of factors, and it's important that you understand these factors because in what has now emerged as the blame game, I want you to see that there are a number of factors that all come together to contribute to the new world. First of all, there is a huge increase in the amount of savings that are available to and wanting to be invested. And let me try to sit at by 2006, there is approximately $70 trillion of stuff in like pension funds, central bank reserves, other places where people are storing up money and it needs to be invested. And there are investment managers on top of that. Two ways to think, because if you're like me, when I use any number past million, you just think of zeros. 70 trillion is if you take every dollar that everybody spends on anything all over the world in a given year, including like buying Boeing aircrafts and you and I going down and get candy bars, you do all that money put together, it's not quite $70 trillion. Okay, so this is a little bit more than the total amount spent on everything in any given year. Big number. Here's the other important fact. Between 2000 and 2006, this number doubles, okay? It was 35 trillion, now it's 70 trillion. You got a whole bunch more stuff that needs to be invested, all right? And you got a bunch of investment managers who are getting evaluated on how well they do on this investment. So, second factor, during the same time period, the Federal Reserve is keeping interest rates low. It's keeping interest rates low because it wants to spur the economy. If you remember, we were coming off the dot-com boom bust, and there was concern that we were going to slip into economic decline. The whole world was sort of, and so we wanted to fuel spending in the United States, so we kept interest rates low. And so if you're an investor sitting with all this cash, investing in T-bills doesn't look so good because the rates are really low, and you're starting to say, where else can I invest? At the same time, we have the housing bubble taking place. I don't have nearly enough time to tell you why. In fact, I have no idea why housing bubbles occur. It's called irrational exuberance, but they do. They have occurred down through the centuries. We were in a very, and it's irrational. That is, people start seeing their neighbors and their houses going up, and they have to get in, and it chases up the chain. And so, if you look at a graph of housing prices, it kind of looks like this over 100 years, and then in the last decade, does this. So we have a huge increase in housing prices. So you have a lot of people saying, "I got to get in that game before that train leaves the station," and so there's a lot of pressure to get into housing. And then at the same time, we have federal policies, both Democratic and Republican, that have been encouraging the home ownership. And one of the ways they've encouraged home ownership is to go to Freddie Mac and Fannie Mae, remember, and say, don't be so tough on your credit standards. Accept looser credit standards so that more people can own houses. And I think if I remember the numbers, we moved from something like 62% of American families to 68% of American families because of this policy. All right, so you've got all these factors coming together. So really, what it tells you is you've got the investors shouting, we want more mortgages to buy. We want to put our money in mortgages. You've got the homeowners saying, we need houses, we want more mortgages. And then you have the federal government kind of greasing the skids with some policies to encourage looser credit and more mortgages. So guess what? We got more mortgages. All right? We got a lot more mortgages. In fact, in just the 6 years, the total amount of mortgage loan outstanding doubles. It was above, I think it was like $11 trillion in 2006. It went up from 5.5. But all mortgages are not the same. If this is the total volume of potential applications measured on the y-axis credit quality, and you say banks set, okay, this is the kind of credit quality we demand for a mortgage, that's the amount of volume of mortgages you can get above that credit value, okay? They filled that up very quickly, and still people were screaming, we want more mortgages. The only way to get that, lower the credit quality standards. And that they did, and they got a lot more mortgages. They lowered the credit quality standards in part by, first of all, saying, well, we don't need as big a down payment. And then they went to, well, you know, we don't need to quite verify your income as much as we used to. They ended up with what they called NINAs, no income, no assets. That didn't really mean that you didn't have to say that you had any income or assets. It just meant that they weren't going to check. So you would come in for a mortgage and you would say, gee, how much income do I need? And they'd say, well, 80,000 would be good. That's how much I make. Really? Okay. Or there were many cases of them showing up and saying, we'll fill the mortgage broker saying, we'll fill the form in for you. And we'll just put some numbers down because nobody's going to check. The mortgage brokers get paid by the number of the mortgages that they put in. And everybody up the stream is saying, if you place it, we'll buy it. We want more mortgages. Okay? So these investors aren't stupid, though, the ones at the top. They know that the mortgage quality is declining. And so they say, you say, why would they buy these increasingly crummy loans? Well, it's the magic of Wall Street, and here's how more or less that works. Simple example. Imagine, and I know nothing about agriculture either, but imagine that you are raising a cow for milk, and you have really crummy grass. And so it makes milk, but the milk is really, really thin, and anybody looking at that bucket says, yuck, that's yucky milk. If you let it sit long enough, however, what finds out is that even yucky milk, a little bit, will rise to the top as cream. All right, that's the fundamental concept of what Wall Street did with these loans. They create a big pool, they throw in all of the crummy loans into a big pool, and then they slice it up into what they call tranches. And they say the first loss that we have in this, out of this whole pool, the people owning that purple thing at the bottom, they're going to have to absorb that loss. But you're going to have a whole lot of losses before you get up to that green pool. And then they would sell interests in each of these tranches. So the top pool, the lowest losses, also the lowest interest rate because the lowest risk, would get very, very high credit ratings, AAA ratings. Middle ones could get good ratings. Sometimes the bottom ones would not even be bothered for rating. They just call it junk. Okay? And that's a sophisticated finance term. Okay? The securitizations, then they would sell these. And they would sell them off to investors. The top they might just sell. The middle ones they might sell with insurance. Hold that concept for a moment. And then the bottom they will put in what's called a special purpose vehicle. Special purpose vehicle is a fancy schmancy, this is what I wrote, fancy schmancy creation that allows these loans to be sitting over here, these lousy, crummy loans, in an off-balance sheet way that means that the company that actually owns that doesn't have to show them on their books. So they've got them sitting over there. Now, I said insurance. You say, well, what's the insurance? Starting in about 2000, there was a growing security that was essentially functioned like insurance. It was so-called credit default swaps, and you're hearing a lot about that now. And basically what those said is, if your borrower doesn't pay, if your security coming out of this pool doesn't get paid, we'll pay it for you. Seems simple enough. But credit defaults, while they function like insurance, were not insurance. So one of the key pieces is, unlike insurance, they were not regulated. Okay? Unlike insurance, these people were not required to reserve for potential exposures. So they would say, sure, I'll guarantee your $2 billion, but you look over here, they don't have anything to pay should that have to come in. They were not publicly traded, meaning you couldn't see. These were all just kind of one-off. Somebody would pick up the phone and say, hey, I've got a credit default swap and I'm selling it for X. You want it? Yeah, here's a confirmatory email. We're done. They were not disclosed. They were treated as off-balance sheet. And here's one of the most amazing pieces. Side bets were possible. And here's what I mean by that. You and I can buy insurance on our house. The house burns down, then the insurance company has to pay us the amount of the house. But if I buy insurance, I can't go buy insurance on Doug's house so that I get paid if Doug's house burns down, but you could with these things. For every one sort of straight insurance dollar, there were $4 of side bets. This was the market betting on how likely it was that different companies were going to go down. Okay? So, one other thing that's important to know, this credit insurer would often turn around and say to somebody else, hey, I might have to pay this if this thing goes down. How about you pay me if this thing goes down? And they would create a sort of a hedge, a backup. That doesn't sound so bad, except what quickly happened is that everybody did it to everybody. And it wasn't like there was one group that was the insurers and one group that was... Everybody was doing everything. And remember, these are not publicly traded and they are not disclosed, so nobody knows who is exposed to what in this process. And you don't know if you're 2 steps down this chain of back-to-back things, if somebody in the middle of the chain defaults, you can be in big trouble standing on the other end of the chain. This is one of the big problems that we have in this whole mess, is nobody knows who has all the bad stuff and exactly where the real risk lies. This gives you a sense of this. Remember I said 70 trillion, about the total amount spent by all people on all things? Starting from virtually zero in 2000, by 2006 we had about $65 trillion in at least nominal or notional face amounts of these insurance. Now that exaggerates the risk because I may have $100,000 of insurance on my house, but my house doesn't, most people's houses don't burn down. But that's the face amount of the risk that was out there. Give you another picture. If you can see this, the chart on the left shows back when it was only 45 billion, how it relates to the total value of the equity in the New York Stock Exchange, the total value of the mortgage security market, and the total value of the US Treasuries market. And it's a huge number, and nobody really understands kind of it. All right, so that's how we got here. Now the table is set. Anytime you have a bubble economy, eventually it's going to burst. And it does. And somebody starts looking around and says, these houses aren't worth as much as everybody's paying for them. And that sets off this huge cycle of things. Individuals begin to default on their loans. Houses are then put up for sale for foreclosure. This puts more supply onto the market and begins to drive down housing prices even further. Borrowers who were anticipating to use the appreciation on their house to pay off mortgages that were originally set at a price they could afford, but knew 2 or 3 years from now was going to step up. All of a sudden, the equity is going the other direction. They can't refinance. They can't get out of it. More defaults, lower prices, and so on. Here's what happens then, and this is the key to understanding where we are. The entire system freezes up. Because you think you've got this whole chain of people. You've got mortgage brokers out selling mortgages, and they're selling them to the banks, and the banks are selling them to the secondary market, and the secondary market selling them to the investors. And somewhere, someone along the line says, I'm not buying anymore. It's like musical chairs when the music stops. And now you've got all of this stuff, and you can't do anything with it. Even if it wasn't crummy, you don't have any more money to lend. And a lot of it on top of it is crummy. And so the brokers are stuck with bad loans, the banks are stuck with bad loans, the special purpose vehicles are stuck with bad loans, the credit default obligors are starting to have to pay and they're going under, and then investors are beginning to write off literally billions and billions. And then banks stop lending. They stop lending because both they don't have any money to lend, and secondly, importantly, particularly interbank loans, which is really what makes our system fluid, they start looking at one another and they say, I don't know how many credit default swaps you have. I don't know how much your other exposure is. If I lend you money tonight, you may not be there tomorrow. And so they stop lending to each other, or the rates at which they lend go astronomically up. And so that starts freezing up. One thing I clearly do not have time is the big companies fund their operations by going in and out of the commercial paper market, and in a related but tangential way, it simultaneously froze up. In fact, it was the freezing up of the commercial paper market that essentially triggered Paulson's decision that, oh my goodness, we have to do something. So here's the key piece. When you take away credit, credit is like the oil in your engine. When you take away the oil in your engine, it will freeze up. And it's what lubricates the system, and you don't have it anymore. And so now instead of borrowing money, you have to wait until you've raised it. Now you start laying off people because other people can't have come and afford to buy your products anymore. The whole system starts to disintegrate, and they said, hey, we need a bailout. The bailout was a guarantee of certain interbank loans to try to get the banks lending to each other. The federal government says, look, trust us. We'll guarantee it if that bank defaults. Not on all of them, but on certain interbank loans. They raised the amount of the FDIC insurance from $100,000 to $250,000. The reasoning being there, they really didn't want people to start going and grabbing their deposits out of banks out of fear, because that would exacerbate this crisis. And then they came up with the great $700 billion, initially said to be buying these crummy assets, but now increasingly looking like to be invested in the actual buying securities in the banks themselves. In either case, the goal is to get that $700 billion of taxpayer money into banks and other entities so it will start the engine flowing again. That's the theory. Big questions. Will it work? A lot of open question on that so far. Is it fair? Almost nobody thinks it's fair. Nobody says we should bail out these people that took really high risk because that's the just thing to do. They say we can't afford not to do it. These entities are now so entangled with all the rest of us, they're too big. If they went down, we'd all go down. We can't afford not to do it. And what will it cost is also another very big question, because frankly, we don't know. The number that was laid out there is not necessarily the number that it's going to end up at, the $700 billion. Theoretically, taxpayers could make a good return on that. Depends on how well we invest. But as a practical matter, almost certainly we're going to lose some of that $700 billion, but we're not, these aren't giveaways. At least they're not supposed to be giveaways. They're supposed to be either investments or purchases of assets, which will have some value. And that will be offset against that $700 billion, and then we'll have to find out, when all the dust settles, how much this actually cost us. But in a very, very quick nutshell, there we have it. See, simple. I got a couple of questions that came in. Why didn't the Fed anticipate this? Well, I mean, that's a question that Congress was throwing at Alan Greenspan, certainly. And, you know, there's this 20/20 hindsight is great. Remember that when Alan Greenspan was trying to depress interest rates, he was trying to solve another problem, and that is that the country was about to slide into a depression in the early 2000s because of the coming off the dot-com boost. There's a lot of people casting blame about who should have seen the housing bubble sooner. It is difficult to, there's a mindset that comes around that. So probably the Feds should have seen this a bit sooner, but it was a bit of a game as to exactly when they would start raising their rates again. And I think, and maybe Doug will say more to this, but I think a big piece of that was to continue to stimulate the economy at a time when they thought it needed to be. Today, the federal interest rate cut its reserve rate again. The way out of this is tricky because right now we've given this, starting to give this $700 billion out to banks, and some of the banks are not immediately going out to lend it. And so people are starting to say, wait a minute, we give you that money so you'd lend it and grease the system and get it going. And the bankers are saying, no, wait a minute. When we made stupid loans before, you yelled at us. Now you're wanting us to push money out the door faster than we think is prudent, and you're yelling at us because we're not making stupid loans. Well, similarly today with the federal interest rate cut, are we needing to stimulate the economy because we're on the edge of tipping into recession, or are we setting up the next crisis by keeping artificially rates low? It's a very difficult thing to kind of balance along the way. Oops, there's more. Taxes. So an increase or decrease will have little to do with this. I'll let Doug do that one. Is there anything we can do to slow the fall of the economy? Oh, Doug is good on that one. I'll let Doug do that one too. How about there's one more video question I think coming.
I'm Ashley Hopper, and I'm a sophomore, and I was wondering, since the government has passed a bill to allot $700 billion to help bail out the banks, I want to know what measures they're taking to ensure that this kind of situation isn't going to happen again.
This is also a great question, and I think the answer is, of course, no one knows yet. From everything I've read, everybody agrees, even the economists, that there should be more regulation. So we will probably see some increased regulation in at least the financial markets. That is, we'll start regulating some of the credit default swaps, requiring more transparency in those areas. Beyond that, it is really hard to predict. There's a tendency in these kind of crises to have an overreaction in the form of regulation and legislation, and often that then creates a sort of a second-tier set of problems that weren't anticipated. But it's very typical to see that happen. So I would anticipate that we will see some significant more regulations coming in. Like most things, you're tending to regulate and protect for the last thing that happened. We had a huge piece of legislation that came in after the dot-com bust, the Enrons and WorldComs and all of that, Sarbanes-Oxley, and that took care of some of the problems that showed up in Enron but didn't anticipate these problems. So I do think we'll see some more legislation aimed at this. Everybody seems to agree that we have sort of what the line is 20th century regulatory mechanisms for a 21st century set of economics. One of the more interesting questions is, will there be any sentiment to say that things should just not be allowed to get that big? That's part of the problem, is these things got so big that you couldn't afford to let them go down because they would take everything down with them. And I'm starting to hear people saying we just shouldn't have things that big. I don't know how you would exactly prevent it and so on. And then while we're hearing that, at the same time, banks are gobbling up smaller banks, and so the remaining banks are getting bigger again. But there may be some effort to sort of cap size or push back on size in some fashion. Okay, thanks very much. I've used my time. I'm going to let Doug take over. And I don't mean to blow off some of the questions that are here. We'll see if we can filter them in as we go along. So.
Well, looking back over history, you can actually see there have been a whole bunch of different kinds of financial crises. And so the question is, can we really learn from that? And can we avoid correcting the old problem without introducing new problems? Well, we'll see it's a little trickier. But one thing you may have been losing a lot of sleep lately over retirement savings perhaps in the stock market, but you really shouldn't have been losing any sleep over money you have on deposit at a bank. Although historically that would have been the case, because historically financial crises were associated with people thinking, okay, I might not be able to get my money out of the bank. And so then you're thinking, well, I better get there before the other people get there, which means you think, well, I better run to the bank so I can beat them out. So runs of banks was a fairly common feature of financial crisis up until finally found a solution for that was the introduction of the deposit insurance in 1935. And that has generally been very successful about ending the problem with bank runs, is that people with deposits don't feel that they need to run there in order to get the deposit back. Now, it can also create other problems, and we'll get into some of the issues involved with that. Well, another problem it was seen pretty clear in the 1930s was not enough funding going into residential lending. Now, again, it's very different from what we're experiencing now. But so that was the creation in 1938 of Fannie Mae as a government agency. Originally the Federal National Mortgage Association, but they later decided, that name is too boring, so everybody knows us by our nickname, so we'll legally change it to our nickname, Fannie Mae. But then the weird thing happened in 1968 when Congress decided, okay, instead of keeping Fannie Mae as a government agency, we'll turn it into this very weird thing called a government-sponsored enterprise, which means that the private owners will get the profits, and if there are any losses, the taxpayers will maybe pick them up, which when you think about it, okay, there's probably a problem with that, but you can see how that worked out. Now, they never actually said explicitly that they'll make good those losses, but they sort of implied that they would. But anyway, so we go back to the 1960s, pretty good time to be involved in residential lending. So particularly with S&Ls, it was called the 363 rule. It's that you pay your depositors 3%, you collect 6% on your loans, and you hit the golf course at 3 o'clock. Very peaceful, profitable life. But what did that in, and if you can get the other window there, happen once you start getting inflation taking off. And so what you ended up seeing is that, particularly in the late 60s and 1970s, you got into a double-digit inflation. Now, for the last 25 years or so, inflation has been pretty benign, so people haven't worried about it as much. I mean, we may be seeing inflation take off again, but lately hasn't been a problem. But what this did was it made it very difficult for residential lenders, because they all of a sudden were finding that they were getting paid back less in terms of real value than they were expecting before the inflation. But there is a silver lining, particularly for the students. If you ask your grandparents if they bought a house, maybe in the early 60s, ask them maybe what their monthly payment was, because what you found is that a lot of people that were able to buy houses at this time ended up doing pretty well. Now, the lending institutions by the 1970s have very severe problems. And it wasn't because of people not paying back their loans. It was because of really just because of the way the markets had worked out, and interest rates were so much higher at that time. So what that led to was moving savings banks more into the idea of doing commercial lending, and that ended up being risky in a different fashion here. So let's imagine, for the movie It's a Wonderful Life, you've maybe all seen that, Jimmy Stewart virtuously running savings and loan. And he looks down the street and finds this other savings and loan, which is now not making loans just for residences, but making loans to a whole bunch of businesses for shopping centers and office buildings and that, hoping to make high enough returns on those in order to be able to cover the losses on the long-term home loans that are still on their books. And Jimmy Stewart's going to say, don't do that. That's too risky. You're risking your depositors' money. But then all of a sudden you realize you're not risking your depositors' money, because the depositors are insured. So even though deposit insurance was a very big help in stemming the problem of bank runs, it also has its own little problem in that people become less careful when they're insured against something. So there has to be a way of regulating the lenders to make sure that they don't take too many risks in that fashion. Now, what finally led to the S&L crash had to do with oil price. Again, remember how particularly this summer everybody really concerned about oil prices? So there was a real problem with oil prices in the mid-1980s is that they fell very quickly. Now, why is that a problem? Well, if you're in the oil-producing regions, that actually is bad. And so a lot of S&Ls then were going under as a result of that. So the problem was happening here is that if we look at the way a balance sheet for a bank looked like, we can think of as the assets stacked up on one side, and on the other side, think of it as the deposits and then the amount of the owner's equity, which is a relatively small fraction of the assets in a bank. So this is sort of roughly what a healthy bank would look like, but what's going to happen once the loans start going bad? Well, they're not going to eat away at the deposits. They're going to eat away at the capital or the owner's equity in the business there. And so if enough loans go bad, you reach the exact point where the owner's equity becomes zero. So a couple of things happen at this point. From the deposit insurance company's point of view, from the FDIC, this is the moment to close the institution down. Because if you can close it down right at this moment, then you can sell the assets and collect enough to pay off the depositors without the taxpayers having to pick up any of it. But if they don't get closed down at this point, from the institution's point of view, they're in a situation, we can do a football analogy here. It's 4th down, 20 yards to go, deep in your own territory. No way you're going to go for it. Unless you're behind and it's the last 2 minutes of the game. Then you're going to go for it, right? And why you're going to go for it? Because you have nothing left to lose. And so the owners of the institutions at this point find, well, they have nothing left to lose. They have every incentive to take as wild a risk as they can, because if it works, they can build up some of their equity again. If not, they don't lose anything because, again, they have nothing left to lose. So what happened with the S&L crisis of the 1980s was that the deposit insurance agencies weren't shutting the institutions down quickly enough. And that's why it ended up being a big bill for the taxpayers there. So what happened then was that Congress passed a bill in 1989 providing for the bailout of the S&Ls and providing for taxpayers' money to do that. And then a couple years later in 1991, they passed a bill called the Federal Deposit Insurance Corporation Improvement Act. And the idea of this law was to mandate early shutdown of institutions and also to make sure that stricter capital limits were enforced so that institutions would not find themselves in this situation where they had the incentive just to go all reckless on you. So again, we're solving this problem, but we're potentially creating another problem, because here's the situation that the S&Ls, or mortgage lenders in general, find themselves in now, is that if they don't have enough capital, they're not able to make new loans because of the restrictions there. And their capital depends upon the value of their assets. And what does the value of their assets depend on? Well, it depends on what the accounting rules are. Now, somehow, accountants have got the reputation as being kind of boring, but you realize accountants have to design rules that are absolutely crucial in cases like this. You know, very interesting, difficult judgment calls that have to be made. And at the time of the S&L crisis of the 1980s, the accounting rules tended to overstate the value of the bad loans, and that led to a big problem because they weren't shut down fast enough and the taxpayers lost money that way. So then they changed the rules, and they probably tended to go a little bit too far the other direction by being too strict in the measurement of the bad loans, making them worth less than perhaps is necessary, making it harder for the institutions to get by because of the limited capital amount they have. And then it also makes it very difficult now in terms of what the government is planning to do, because originally, like 3 weeks ago, the plan was more along the lines of buying up a bunch of the assets from the institutions that were in trouble. The problem of buying the assets is it totally depends on how much you're going to pay for them. Because if they paid for them too little, it's not going to help the problem. They're not going to be able to build up their capital again. But if you pay for them too much, well, you have a problem with that in that you're bailing out the people that were taking the risks in the first place. Now, regardless of whether you think that's fair or not, there is a real problem if you bail them out too much, because you may, the government now may promise, okay, we're going to bail you out now, but we're never, ever, ever under any circumstances going to bail you out again. The problem is it's kind of hard to make that promise credible, because people are much more likely to look at what you actually do rather than what you say you're going to do. And so if you bail them out once, there's always people who are going to think you're going to bail them out again. But if people are expecting a bailout again, you're much more likely to have people take more risks and end up getting into some of the same sort of situations like that. So how can you recapitalize the institutions in a way that's provides enough funding to build up the capital without also providing them so much funding that they end up being a generous bailout that you end up with a systemic risk is still there? It's going to be a pretty delicate balance. And lately, the approach from 2 weeks ago is now more along the lines of buying the equity stakes in the banks. And they've at least structured it along the lines that the institutions that sell their stock to the government will have an incentive to pay it back early. And if the institution stock price goes up in the future, the government will have an option to buy the stock, so the government will be able to make some profit out of it. So what that means is that we can hope, if this works well, and again, who knows how well it'll work, but if it does work well, at least some of that initial investment will be coming back in terms of payments from the institutions that have been, received the funds from the government now, but then the government will be getting some of that money back later on. And then just one final thing is that in the last year, you do have a problem when the policy is kind of inconsistent, because you need to ask, okay, what is it that makes Bear Stearns back in March get like a mini bailout? I mean, they only got like $10 a share, so it wasn't much of a bailout, but still it's better than zero. Whereas last month, Lehman Brothers gets zero. But then last month, AIG gets a bailout. Whereas also last month, Washington Mutual shareholders get zero. The Washington Mutual depositors, get all their money, but the shareholders get zero. So the problem with being inconsistent like that is you're really, okay, so what is going to happen? I mean, how are we supposed to react if we don't know, when there's going to be a bailout and when there's not going to be a bailout? And so what, how the policy is going to work out there. So one of the common themes, again, is that you can usually figure out the answer to the last problem. The problem is how you can figure out the next problem. Now, in terms of the market for mortgage-backed securities, the good news is the lenders, I think, learn their lesson. Once you get burned like this, they're not going to do the same thing again as long as they're not bailed out. But in terms of the systemic lessons, well, we'll see how well we've learned those. So.
Give you a couple questions.
Okay.
So let's see. Doug, somebody has written, will the Treasury really be able to borrow all of the $700 billion, and won't this increase our reliance on the Chinese?
Good question. Will they be borrowed? Well, sure. There's no problem. They're going to be able to borrow it. I mean, no doubt about that. If necessary, if the Chinese won't lend enough of it, they can borrow it from the Federal Reserve. The Federal Reserve has the printing press. They can print as much as they want to. The risk of that, as you may be able to think about, is potentially the risk of inflation, although that's somewhat ameliorated, is that if you're having a lot of assets collapsing, then that's going to tend to have a depressing effect on spending, which would tend to somewhat counteract the risk of inflation. But here's the optimistic news, okay? Is this 1929 again? Well, I think not. And the reason is we actually have learned a lot since 1929. I mean, the economy is very, very complicated, very, very difficult to understand, but I think we've learned enough not to make the same mistakes of 1929 and leading to the Depression, which again lasted for a whole decade. much more likely perhaps might be a period of inflation, because the government, being a big debtor with their control of the printing press, much more tempted to cause inflation rather than go through depression again. So maybe that makes it a little bit more optimistic view.
Take another one here. I think somebody was asking me, how were side bets legal? The short answer is they were just contracts. I agree to pay you if this happens. And there was no agency that was charged with regulating. At one point, there was a concerted, some people early on, I think it was in 2005 if I'm remembering right, said, hey, these credit default swaps are getting really big. We need to regulate it. And there was some move at the regulator level, and the industry went to Congress. And if I'm remembering correctly, it was 95 to nothing, the vote in Congress to prohibit regulating these things, supported obviously by both Republicans and Democrats, championed by the Clinton administration at the time. And the underlying rationale, as I understand it, is only really, really smart, sophisticated, big players are playing in this market. Surely we should leave them to make the right decisions because, I mean, you know, they're big boys and government shouldn't mess there. The piece, of course, that was not factored in is, again, that notion that they were so big that they could bring down the whole house. At which point, then you do need, there is a justification for regulating. But the underlying, so they were not simply not regulated, and anybody can make that kind of contract unless there's some prohibition against it. Maybe one more. Doug, actually, you want to show? I think there's one to show. This is essentially the same one as on here.
Greetings, I'm Corey Deppy, also a senior here at Duzer. I'm wondering what sort of ramifications there'll be from these shock waves to the international economy on nations maybe that are really trying to step into a safe place and are not making it.
As you may have noticed by looking at what's happening, is that this is not just in the U.S. It's issues in a lot of other places. Europe has, several countries have adopted similar kind of proposals related to government equity stakes in the banks and trying to stabilize their system that way. And part of it, again, was because the mortgage-backed securities were attractive enough that a lot of savings were driven to them. And I know that China can be a very interesting place, but it can be very complicated for an outsider to understand. So I can imagine from the Chinese point of view, trying to explain the difference between Fannie Mae and Freddie Mac and a government security probably wouldn't make sense. I mean, it really doesn't make sense to an American, but trying to explain it to a foreigner, would even make less sense. But I think part of the problem again is, I mean, the government could have just said, Fannie Mae and Freddie Mac, okay, you're private companies. I mean, sorry that we sort of led you on by making you think we were government agencies, but you're not. One of the problems, if they had done that, is precisely the international problem, is that it probably would have been very, very difficult for the U.S. with countries that had invested in these securities that, thought that they were somehow receiving the backing of the government. Now, again, what happened is that Fannie Mae and Freddie Mac, they were able to borrow at rates that were less than they would have been if they were just an ordinary private company, but they were borrowing at rates that were higher than on regular Treasury government securities. And that's why they would be more attractive investment than you just sort of plain old Treasury securities there. And so that's probably one of the reasons why what's happened to them is they've been put under what's called conservatorship, which means like if the government regards you as totally incompetent to manage your own affairs, they appoint somebody to run them for you. So that's what they're doing with Fannie Mae and Freddie Mac now. And so that probably reduced somewhat what could have been otherwise the international fallout from that issue.
The only other thing that I've heard is that there's a very high expectation that nations that are heavily dependent on foreign aid are going to be particularly hurt by this as countries start pulling back their foreign aid.